Is it possible to deliver absolutely blockbuster earnings, smashing expectations, only to have the market treat your stock like, well, like a one-hit wonder? That's the reality Spotify, ticker symbol SPOT, seems to be facing this morning. Welcome to De-Risk, a podcast where we provide a no-nonsense analysis of stocks. This deep dive, it's based on our research captured early on November 4th, 2025, around 7:40 a.m. Eastern, and it's really dedicated to solving this fundamental mystery. Why is incredible fundamental growth being, actively ignored by the market?
Let's try and unpack the tension here. So when you look purely at the numbers, it should be a celebration, right? Spotify delivered earnings per share of $3.83. That absolutely obliterates the $1.87 expectation, just destroys it.
Yeah, obliterating is the right word.
And revenue also beat forecasts. It's fueled by surging users. They now top 700 million monthly active listeners globally. By all measures, this should send the stock soaring. It absolutely should, yeah. And look, the street agrees long term. What's fascinating here is the sheer disconnect. Analysts, overwhelmingly bullish. You got, 70% rating the stock a buy or strong buy? And our models suggest a fair price around $713, which is a significant premium over the current price, near $644. But right now, value, it's losing the argument to fear, plain and simple.
Okay, so we have this $713 target floating out there, but the stock is dropping nearly 2% in pre-market trading as we speak. What is this fear factor? What's going on?
Well, we've got sort of dual headwinds creating what I like to call static in the transmission. First, it's the severe macro environment. You just look at the pre-market futures, they're grim. The tech-heavy NASDAQ is down 1.3%. And if you connect this to the bigger picture, consumer income growth is slowing. Slowing to levels we haven't seen since the post-financial crisis era.
Right. And why does that matter specifically for Spotify?
Because that critical 25 to 54 age group, their core premium subscriber demographic, they start pulling back on discretionary spending when things get tight. And premium music subscriptions, they're often one of the first things to go, unfortunately.
Mm-hmm. And if the macro picture wasn't enough of a headache, there's that other thing, that non-financial risk that just seems to stick like glue. The class action lawsuit.
Exactly. You can't just dismiss the impact of a significant legal headache. We're talking allegations of streaming fraud, potentially distorting royalty payouts. The market views this as a massive future liability risk. Not just financially, but, reputationally too. It threatens the high margin deals they need to secure. It effectively introduces this major uncertainty discount on future earnings, regardless of how great the user growth looks today.
Okay, so here's where the market's true verdict maybe is revealed. What happens when the crowd gets presented with really great news during a hostile macro environment? Our research shows skepticism is just running rampant.
Yeah, you absolutely have to look at the options market here. The sentiment, it's clearly bearish. The put-to-call ratio sits at a bearish 1.56. To put that in context for you, that means for every dollar put toward bullish calls, traders are betting $1.56 that the stock will fall. So skepticism is running hot. And we also see this massive wall of bearish bets stacked precisely at the $650 strike price. That signals where traders expect maximum resistance, like a ceiling. Couple that with a meaningful 4.4% short interest. This is a pretty profound vote of no confidence from some market participants.
Wow. Okay. And the technical story completely supports the bears right now, doesn't it? The price chart seems to be just ignoring those fantastic earnings because that powerful upturn we saw earlier, it's reversed. It's now a clear pattern of lower highs and lower lows.
That's the key technical breakdown, absolutely. And volume confirms this. It shows clear money flowing out of the stock, not in. Momentum as well, it's entirely lost. That signals a sustained kind of professional push from sellers who are prioritizing risk reduction over, celebrating a stellar quarter. Ultimately, the refusal of the market to celebrate phenomenal good news. That's the massive red flag in this hostile environment. So our final verdict, it remains a neutral with a bearish bias.
Okay, neutral with a bearish bias. So if you're tracking this closely, the key battleground levels for maybe the next few sessions are what? That $650 level.
Yeah, $650. It's transitioned from support to what looks like a firm ceiling now.
Right. And the next significant support level below that.
That sits down at $630. That's the next potential floor to watch. And look, the only way to really invalidate this bearish view, this current setup, is a strong, confident close back above yesterday's high. That was roughly $662. Until that happens, until we see that kind of strength, the bears really control the playlist here.
So Spotify's user numbers are hitting this incredible high note, right? Demonstrating world-class fundamental strength. But its stock chart, it's playing a pretty sad song right now. And this just reminds you that in a risk-off environment like this one, even 700 million users can't always buy you immunity from market fear and technical weakness. That's all for this deep dive. Remember, this podcast is for informational purposes only and isn't financial advice. Please do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.